Hello, hello, hello. Good afternoon, everybody. And my name is Stephen Padernacht, and welcome to another episode of Mortgage Matters. And can you believe it? We've actually hit episode 10. I guess time flies when you're talking mortgages, right? So guess what? Today we're shaking things up a little bit. We've got a cool guest on board, Micah Smith. And why do we have Micah here today? Well, because credit is a big deal in the mortgage game, and Micah's got the lowdown for us. No frills, just straight up insights on navigating the credit maze. So I'm going to start off with inviting my co-host, Christian Babcock, and we'll go over some mortgage news, and then we'll invite Mike on. Christian,
What's up, man?
how are you, buddy?
I'm good. How are you?
Oh, you got a suit jacket on today.
I gotta dress it up for you. What's going on?
Yeah. It must be because of the special episode we have today, huh?
Yes, absolutely. That's exactly right. I know Micah keeps it on point, so I gotta keep up to her level.
I hear you, man. I hear you. So, how's your week going so far?
Good. My business is picking up. I'm definitely getting some people that are putting contracts together. There's some more inventory coming on, but still somewhat short. But still a lot of buyer demand out there. Just got to find them houses. But we're definitely, I'm for certain, personally picking up quite a bit in the last couple of weeks. My mortgage rates are holding somewhat steady. I mean, we got some weak economic news this week with the unemployment rate going up, jobless claims, things like that, which would cause rates to take a little bit of a dip. I mean, last couple of weeks, they an average 30-year fixed, you just saw in the headlines, came in just above 7%. Now we're just below 7% on an average 30-year fixed. But next week we got inflation reports coming out again. So, keep your fingers crossed. Things are going to start, going down. We'll see. Still keeping hope alive.
So refresh my memory. We're hoping for inflation to go down, correct? And then that will help affect the rates?
Yeah, we're looking for a cooler inflation report, month over month, which we're seeing towards the end of last year. But then February's report came in hotter than expected, which caused that spike. So, now that the March reports are coming out, which are reporting on February, if it comes in cooler, we'd like to see a little bit of a dip coming into the spring. Let's hope.
Yeah, I mean, I went out for groceries the other day, and I put literally 7 items in the basket, and I'm paying $150 for eggs, bread, and milk. It was insane.
Yeah, it is for real. And it's and inflation, it's absolutely everything. It just it kind of seeps its way into everything, and it always trickles down back to the consumer. And if incomes aren't going up at the same pace, that's where you start having some real problems, which is also why credit card debt's never been higher in the history of the country. You're seeing, a lot of companies do, even companies like Affirm or, where the buy now, pay later things are getting very popular. So we could be seeing, it's a little bit of a breaking point when it comes to personal income and debt. Which is why if you do own property, if you're lucky enough to own property right now, a lot of people are looking into home equity lines of credit, cashing out, refinancing to consolidate a lot of that debt. And wipe, kind of hit the reset button and, push everything into their mortgage and save some money, so it's just another real benefit of owning rather than renting, because you always have that option.
Gotcha. So just in reference to the HELOC or the home equity line of credit. So essentially, if somebody owed money on, let's just say, credit cards or personal debt, they could tap into that equity somehow and then roll it all together into the equity that they have in their house.
That's actually right. And then, I just did one for a client where, they had maybe $40,000-$50,000 in additional debt on top of their mortgage payment. And by consolidating everything, it's, and that's what we're going to be seeing in the next few years, because people do have so much more equity because of rising home prices that, this client was we were only financing 60% of the overall worth of the property. We consolidated 4 different lines of credit and saved over $2,000 a month all in, even though the mortgage rate that we gave, the new mortgage rate we gave him, was about 2% higher than the one that he already had. Still save over $2,000 a month by consolidating it.
because they're not getting hit with those 20 and 25% interest rates on the credit
Right.
cards.
And then, and those are just on the minimum payments. That was not him hitting the balance at all. It's $2,000 a month overall monthly savings based on the minimum credit card payments.
Interesting. All right. So buzzword credit. So what I'm going to do is I'm going to invite Micah onto the stage just so we can kind of get her insights into credit. So let's see how to do this here. This is our first time having a third guest. So let's see how this goes.
There she is. Oh yeah.
Oh, there we go. Hey, Micah.
How are you? Hi.
How you been?
Wonderful. How about you?
Good. No complaints. Keeping busy.
Good. Yeah, absolutely. Awesome. Thanks for having me.
Absolutely.
Hey, Micah. So how awesome is it to have Christian live on social media almost every week talking his expertise? I get a kick out of it.
I love it. How long have I known Christian? How long have I known you? Pretty much since the beginning of my career, I think.
Really when you first came to New York, really,
yeah. So no, it's great. It's always great to see Christian anywhere. Live, in person, all the above.
So Micah, tell us, just tell our viewers just a little bit about yourself and about your company and maybe your expertise in helping people repair their credit.
Absolutely. So I've been in the business for about 11 years now. And as Christian remembers, I worked for a very large firm for a very long time. And they were actually a pretty good company. And about 3.5 years ago, I saw the writing on the wall and I was like, I have to open my own firm. I really felt a pull and a calling to do so. And so the first year of my business, I did pro bono work. And so we've actually been open to the public for 2.5 years. And it's been an amazing journey thus far. I've got an incredible team. I'm happy to report. It's been the hardest thing I've ever done in my life is building a team, and the right team at that. It's easy to bring on people, but the right people, that's a whole nother ball game. And so it's great. That's all we do all day, every day is we help people who are trying to restore and repair their credit back to a healthy state. And we primarily partner with the mortgage industry. So the real estate sector, the mortgage companies, because obviously, saving that huge chunk of change when you can lower that interest rate is really important, so we want to pass that along to our consumers, that savings. So
makes sense.
Yeah.
So
yeah.
Christian introduced me to you as well.
Yes.
And
yes.
I don't know if you remember this, but I've never in my life dealt with credit repair, and you actually connected me and got me started on my first credit repair. And this was about probably 5 or 6 years ago.
Yeah.
And so personally speaking, people, I could tell you that my credit after working with Micah jumped up tremendously just over the course of, I think it was about 6 to 8 months was when I really you would see little things happen, but then there was a huge spike.
Yeah.
And so
that's usually how it happens. It's all of a sudden it's boom, one day. Yeah.
Can you tell us just a little bit about the process? Somebody comes to you and they say, hey, I'm trying to buy a home, or I'm trying to fix my credit so that way I could, make some moves. What is the process like? And what is it that you guys actually do?
Yeah, of course. Absolutely. So when someone comes to us, what we do is first things first, we always do a soft pull tri-merge. That's step number one. So a soft pull, obviously, it never impacts your score. A tri-merge is just a fancy way of saying all 3 credit bureaus. And so what we want to do is we want to analyze the credit report. We really want to dive deep. And so it's a 10-year report. And so we're going to be able to see everything that the client has done for the last 10 years. So positive, negative, see if they've missed payments, if they have collections, charge-offs. So sometimes we'll get clients that aren't a good fit for our program. And if they're not, we'll direct them to an appropriate place, that makes sense for them. And so, but once we actually have the report in hand, we review everything with them. So when I teach my classes, I'll have a little pie chart with me. And I always talk about the importance of positive credit. And 30% of your entire credit score comes from positive credit. So how you manage your credit cards. And so, we were just talking, or Christian was just talking about debt and how high it is. Well, we review that with them and we give them different methods as far as how to attack their credit card debt, because it does impact 30% of your credit score. So not only is it very stressful, but it's also impacting your credit score and everything else that you have. So we review that with them. And then we also go over the negatives and we set them up with realistic expectations as far as how our program program works. And so making sure they understand, listen, as you go through the repair process, it's not oftentimes a quick fix. It's a lot of times a 6 to 12 months type of a time frame. So we want to make sure that they understand that, so that they don't have these unrealistic expectations as far as what is going to be happening over the course. We have people all the time. They're like, great, I'm going to be fixed in 3 days, right? And we're like, no, 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 no. Like, it's not that simple. And so we just want to make sure that they have those expectations. And so as they go through the process, so just to give an idea of what the process looks like is, so we're fighting on behalf of a client at the bureau as well as at the creditor level. And so when we go, like, say you have like, with a medical collection, right? We're going to the credit bureaus and we are fighting on the client's behalf. So we're sending out a list of investigations. The investigations go from the bureaus to the creditor, back to the bureaus, back to the client. And then that whole process takes 30 days. And so we are continuously repeating this cycle month after month after month after month until we get the results we want. And so what people don't realize, and it's funny because people will get results back from the bureaus in the mail, and they'll get something back that says, oh, the bureaus have verified this. And they'll be like, oh my gosh, they verified it. Is it over? And I'm like, no, it's literally just begun. I'm like, you have no idea how templated the bureaus are. And we're constantly, like, we have no shortage of things when it comes to, and we're upholding the laws, which is how we get things off in the first place. But we have no shortage of things to send them when it comes down to the investigations themselves. And so it's just, we've really seen that persistence overcomes that resistance. And trust me, the creditors and the bureaus are very, very resistant. They're not just going to fold. You send an investigation or a dispute, right? That's a lot of what most people know is dispute. You send it in and they're not just going to fold. Like, you don't just send it in and it just goes away. Like, you have to have a valid case. And so that's what we're doing on a client's behalf, is we're presenting that valid case to essentially try to get the negative items removed from the credit report. And that's probably one of the biggest things. People have a challenge of understanding what we're capable of. And they're like, how are you able to remove something that I did? And I'm like, because it has nothing to do with, did you do it? It has nothing to do with, did you do it? It has everything to do with how is it reported and can they verify it? And that's really what it comes down to. And that's that's a very, 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 very short summary of the Fair Credit Reporting Act.
Gotcha.
One of the things, Steve, if I could jump in. I mean, one of the things I learned from you, Micah, a long time ago was, and which was a surprise even to me. And if you could touch on, like, when it comes to credit scoring, the percentages, like you mentioned, like the 30% credit card utilization. Can you just touch on, like, what has the greatest or least impact on a credit score when it comes to those types of percentages?
As far as, so what do you, wait,
like credit card utilization, is a certain percentage of your score. What a mortgage payment, an on-time mortgage payment, installment debt versus credit card debt, and like what those look like, how much of a late payment takes off your score versus a high balance credit card, things like that.
So you want me to go through the pie chart?
Yeah.
Yeah, for sure. Yeah. So I'm sorry, I wasn't sure exactly what you were asking. So I felt like there was like 15 questions in one. So I was like, which one do you want me to answer?
Without having the pie chart, the pie chart.
Absolutely. Yeah. So 35% of the credit score does come from payment history. And so anytime you do anything good or anything bad, it shows up right there. So one of the bigger statistics that I do give in my classes is if you miss a payment. So I briefly touched on, so revolving debt, so store cards, credit cards, lines of credit, they impact 30% of the credit score. So when you're looking at the pie chart, you've got 35% that belongs to payment history, 30% that belongs to credit cards. So comparatively speaking, right, when you are looking at the pie chart, there's a little section over here that's going to be 10%, and that's where all your installment loans fall. So your $500 credit card is going to actually weigh more than your $500,000 mortgage, because your installment loans are only 10% of your credit score. So credit cards, being this big chunky 30%. And so, like, God forbid, let's say, so one of the biggest things I always talk about in my classes is missed payments and what happens when you miss a payment. And people think it's no big deal. And I'm like, well, let's go through the statistics. And so the principle is, right, the higher you are, the harder you fall. So if you have a true perfect credit score, which is totally unnecessary, say you have like an 850 and you have one 30-day late on a credit card, let's just say it's your minimum missed payment. Let's say it's your Nordstrom card. Your score will drop 180 points.
What?
For one 30-day late. Just
What?
one. And then it takes, so organically, say you don't even know that my company exists or that my field exists, organically for you to fully recover back to your 850, it's going to take you 7 years. And that's the biggest problem that we're seeing to date, is because people will be faster to pay their credit card bill, or excuse me, their cell phone bill over their credit card bill, and not realizing their cell phone carrier, say Verizon, isn't reporting to the credit report, but they're faster to pay their cell phone bills than they are their credit card bills. And so the importance of making sure that they make all their payments on time is absolutely critical. So it really is unbelievable how much weight our $500 credit cards have versus our $500,000 mortgages. People just really have no idea. And a lot of people too, they think, oh, it's my student loans. I literally get that probably 10 times a day. They're
You
like,
and me,
it's my
you and me
student-
both. You and me both. When I ask how your credit is, oh, I got some student loans. Like, all right,
Yes.
well,
Yes. And it's like, wait, that doesn't actually impact your credit score in a bad way. It's a lot of debt, but it's not looked at or calculated the same way as a credit card. So a lot of people have student loans that have now surpassed the limit because of the interest, but that really is having very little impact to the credit score because it's looked at the same way as like a mortgage, the same way as an auto loan, same way as a personal loan. So it's an installment loan that carries, right, very, very little weight, and they don't actually look at the balance, comparatively speaking, to the limit and really hold it against you. So people often get fixated on, oh, it's this, or maybe it's the inquiries. We'll definitely talk about inquiries in a little bit. But I swear the two biggest things people always think is they're like the inquiries and their student loans are what's bringing their scores down. And then we look at the credit report. I'm like, no. It's your credit card utilization. It's your 3 collections, and it's this brand new charge off that you just acquired. And they're like, oh, you can see that?
yeah.
Yes, I can see that.
Exactly.
Yeah. Was that what you wanted me to cover? Hopefully.
Yeah, no, 100%. And then,
Okay.
and you also touched on an important point, because I remember, like, we have some first-time homebuyer courses with different loan programs, and in those courses, literally tells people, not that you would ever advocate missing a payment on anything, but really a priority list of bills that you make sure you never want to miss versus ones that you can miss if you had to. So if you had a limited amount of money per month to spend, what's on a credit report? So you touched on it, mortgages, student loans, credit cards, those are all on a credit report versus a cell phone bill is not, unless you never pay it, then it might go to collection or judgment. But the credit, your insurance doesn't go on a credit report. Your cell phone doesn't go on. Your utility bills don't go on. So you never want to miss those payments. But if you had to miss something, you want to miss the ones that are not on a credit report.
Exactly. 100,000,000%. And not to mention, I mean, it's again, we're not encouraging anyone to miss it, but even your rent doesn't report to your credit report, right? Your landlord might be pissed and you might get a late fee, but at the end of the day, you know what I mean? So we just tell people, like, just be cognizant, what's really gonna, and then on top of that, so I don't know if people are aware of this, but when you miss a credit card payment, they now add an additional type of interest to your credit card. So you're now getting hit with a special type of interest that is just for those people with late fees, or those late on the actual credit cards. So
it's like a default interest, right?
Mm-hmm.
It's like 100%. A default interest.
It's brutal. It's absolutely brutal.
So that 20% now becomes like 35%, and it starts compounding.
Yes, exactly. And so that's, I mean, they're already high as it is, and that's due to short-term interest rates being raised by the feds. And that was something that they did on purpose to offset inflation. That was something they announced it 1,000 times. And, we tried so hard to be proactive. Like, listen, if you have credit card debt, make sure to pay it off, because they're going to make it harder for you to pay it off if it's not paid off. And that's exactly what they did to offset inflation. They raised short-term interest rates multiple times in order to get people to stop spending. So this is part of what we're seeing here is on purpose. And that's what people don't realize.
And unfortunately, it's not working. Because people are still spending.
They're still spending. It's slowing down a little, but not much, right?
For me as a realtor, I see it all the time, right? Like, so I have a call come in and they're like, okay, I'm interested in 123 Main Street. I say, okay, are you part of the initial conversation? We're talking about, are you pre-approved for a mortgage? A lot of times they say, no, we're not, but don't worry about it. We'll be okay. I say, all right, so do me a favor. Just give me some sort of brief overview about, your financial situation, just so I can kind of determine, off the bat, I've been doing this long enough. Tell me, what's your yearly income like? What is your estimated credit score? And they say, oh, well, I'm working on my credit. I say, okay, what does
I
working
know where
on
you're
your
going with this.
what does working on your credit mean? And they, I'm trying to pay this off, and I'm trying to consolidate, and I'm trying to do all these different activities. So can you consolidating loans or consolidating credit, is that a good thing, or is that a bad thing? I mean, do you recommend people doing that, or how do you view it in your industry?
For sure. So there's two things I actually want to address that I think that you just touched on. So first of all, not having a pre-approval. So they're telling you their credit's okay. So they're seeing a score probably on their bank app or Credit
Or
Karma.
or Credit Karma, yeah, or
We're
one of
definitely
those
going to go
sites.
over that.
Credit Karma.
Yeah, it's like the biggest pain point ever. And so we'll touch on that one, and then I'll go through the consolidation because I definitely want to talk about that as well as counseling. So if they're looking at their credit scores themselves, this is one of the biggest things that we see. And people are like, oh, I'm doing fantastically. And then they go to Christian because they should absolutely always have that pre-approval in hand. Christian pulls the credit, which, by the way, here's a little tip for everybody. It's 2 to 5 points. A hard pull, when you go to Christian, it's 2 to 5 points. And what he's pulling is your score right then, right there at that time. The hard pull itself, the points, they don't even show up until 30 days later. So that's your actual score in the mortgage industry. It's a different algorithm. So Credit Karma on average is 40 to 60 points inflated compared to the mortgage industry. That's on average. Worst discrepancy we ever saw was a 200-point differential. We saw a young lady, she had a 640 on Credit Karma. Her lender pulled the credit, it was a 440. But it was because she had charge-offs
Lord.
from 3 and 4 years ago. Credit Karma only calculates the last 2 years of history. So that's one of the biggest reasons you're going to see such a strong inflation compared to what actually Christian will see. So if you're looking at Credit Karma, right, just be aware lenders don't use that, right, to calculate your credit score. So you want a great resource, myfico.com. It's 100% accurate. It's a soft pull. It will not impact your score. Request your mortgage scores. It's 5, 4, and 2. Those are the algorithms that you're going to actually want to see, and you'll see your mortgage scores. It's 100% accurate. So Credit Karma is great for what's going on right here, right now. But don't use that thinking a lender is going to pull the same thing. It's just not possible. And then as far as consolidation, so we love consolidation. Consolidation is great. If you can go out and you can get a loan, you can get an installment loan to pay off all of your debt. Great. That's amazing. We would encourage it. You can probably get a lower interest rate than what you're currently paying. Your scores are going to go up because all of your credit cards are going to come down. Keep your credit cards open, right? So we love consolidation loans. If you can qualify for it, we love that. However, a lot of people don't qualify for that. So one of the biggest things that people are getting involved in right now that we want people to stay away from, very, very far away from, is credit counseling. So credit counseling, so the only way you can negotiate with a credit card company when it's in positive standing is if you start defaulting. So once you start missing payment after payment, so it's very similar to loan modification in the mortgage industry. So once you start missing payment after payment after payment, what these companies do is they literally instruct you to stop paying your bills. Right. And so they'll say, well, you're going to start paying us instead. We're going to put this money into an escrow account. And then over, whatever period of time they give you, 3 years, 4 years, 5 years, they're going to pay off and settle all your debt.
That
Well,
sounds
not
scary. That sounds scary. I gotta just say, that
terrifying.
sounds really scary.
It's terrifying.
Terrible.
It's
Honestly, it's
terrifying.
terrible because I see this I've seen it so many times on the other side, and it's heartbreaking because I'll get people that say like, oh, I'm in credit counseling. I run their score and it's like a 400, 500 credit score and they don't know why. And I always have to have that conversation, like what these companies leave out is that, yeah, you're paying them now, but that doesn't mean that the debt is still there and they're accumulating late payments every month with that also eventually go to charge-off status because they're trying to negotiate down the debt for you, yes, but they destroyed your credit.
Well,
You know,
what's even worse is that I have clients who they So not only did it go into that charge off status, but because they took so long to negotiate and pay things off, the sheriff came and served them papers and they're getting sued.
Wow.
And the company is like, oh, well, you can pay us an additional fee and we'll fight that for you. It's like,
Yeah,
what? And
terrible.
it's like they're paying more than what the debt is worth. They've destroyed their credit scores completely. And now it's like they're in a situation that it's going to take them time and money and effort to get out of with, someone like myself to hopefully help them repair the credit. But it's one of the worst mistakes we see people make by far. So, I mean, there's so many options to not only, so if you have a home and you're in that position, obviously, Christian, you touched on some great points. We encourage people, look into getting a HELOC, do a cash out refi, something of that nature. If you don't have that option though, there's a couple of things that you can do, worst case scenario. So call the credit card company, close out the credit card. It'll stop accruing interest, come to an agreement for, a low monthly payment that you're going to make them, just pay off the credit cards. It's better than going into those credit counseling situations. Call them, negotiate the interest. People don't realize you can call and you can negotiate your interest rates. Like people forget about that all the time. There's lots of little things that people can do outside of these credit counseling companies. And it's something that it's just, we hate seeing it. And it's honestly very sad. It's predatory in my opinion.
When I was about to say, when you were talking about that, the first thing that honestly, like it sounded so terrible that it felt like somebody was scratching a blackboard. Like it sounded so terrible. And in my mind, I'm saying to myself, how is this not predatory? Like you're saying, like
they always leave that part out about what it's doing to the person's credit, and the consumer doesn't know to ask that question. Like they're just going for help. So unless they're telling them like, hey, this is what we're going to do for you, but you need what they should do is say, but what you need to know is by doing this, your credit is going to go down significantly for the foreseeable future.
Yeah.
I mean, I bet you if they told people that, they'd be more hesitant to go into the counseling.
Oh, yeah, absolutely. Absolutely. Yeah. Oh, by the way, this is going to impact you for 7 years. No big deal.
Right. You'd be better off declaring bankruptcy, quite frankly. So
a lot of people would be. Absolutely. I agree with you there.
Micah, you mentioned this term a couple times, and I just want to clarify it for some of the viewers. Charge off. Can you just talk a little bit about what is a charge off, and is it good, bad, or just kind of like a brief overview of that?
Yes, I love talking about charge-offs. So I really do. So charge-offs.
I'm talking about mortgages.
I love talking about real estate. Look, we're all here.
It's so interesting. I love my world so much. And I love explaining these things to people because people don't understand what these terms mean. And so a charge off. So say for instance, you have a Capital One credit card and Capital One. So when you have a credit card with Capital One, any unpaid debt that you owe them is considered an asset to their company. So your current Capital One card is an asset to Capital One. They pay taxes on that debt, right? Because again, it's an asset to them. So if you have a balance and then all of a sudden you default on it, and so we'll call it for ease sake, we'll call it a collection. So after you've gone 30, 60, 90, 120, 150, 180 days past due, they will charge it off. And so it's simply verbiage. So it's no longer considered an asset to their company. So it's a collection and a charge off. So a charge off is something that an original creditor, it's just verbiage that an original creditor will place onto the item that was defaulted on so that they no longer are paying taxes on that debt. So it's also considered a collection as well in our world. But in the mortgage world, collections and charge-offs are a little bit different. So, but at the end of the day, just know it's when an original creditor has a balance, they're no longer going to be paying taxes on it, and it's something that is absolutely due. So a client will need to pay it. So there's a certain amount of time legally that they can try to pursue and collect on that debt. So there's a lot of misconceptions that if I have a charge-off, I don't owe it. That's not the case. You absolutely do. They can come after you. They can pursue you for the debt. In the state of New York, the amount of time that they can legally pursue you for that debt is 3 years. So it's from the date of the first missed payment. So that caused it to go into default. So hopefully that provides some clarification. And sometimes what will happen is sometimes it will actually in turn become 2 separate trade lines on a credit report. So we'll see an original creditor will sell it to a third party, a collection agency, And then it will be a satisfied charge off, which causes damage. And then the third party collection agency will now also be on the credit report. So you'll have a couple of dings there listed on the credit report when something is charged off. It's a negative.
It's a negative, right? It's a bad thing. So when you see
It's a bad
charge off, and and how much does it impact if you were looking at your pie chart? It impacts as part of that 35%.
No, so it's gonna depend. So we don't cover that in the pie chart. So the charge off is gonna, so it just depends on what else is on the credit report. That's really the best way to explain it. So
Usually what precedes the charge off is a whole lot of lates, and that's already done the damage. You know, so
yeah. Yeah, so it's definitely a negative. So the way that we explain charge offs or negative items, the more recent it is, the more impactful it is. So if it's something that just happened, it's going to cause a lot of damage. And charge offs, a lot of times, and again, it can apply to things like auto loans and things of that as well. But like say it's a credit card. If it's a credit card, the problem is that balance has usually exceeded the limit. And then, so not only are you getting dinged for having a negative item, a charge off, right, a collection, but you're also getting dinged for having a credit card that's over the limit. So
Right.
it's a really damaging item to have on the credit report, especially if it's new. So depending on what else you have, it could be a 100-point drop, it could be a 60-point drop, it could be, there's so many variations as far as how much you can impact the score, but it's heavy.
You know what stuck out to me so far in the past while we've been talking is the higher you are, the harder you fall. I'm baffled by somebody with an 850 score can drop down 160, you said, just from one missed payment.
I've seen it. I've seen it. I've unfortunately seen it. When I've had somebody pre-approved with an 800 score, and then 6 months later, when we do the actual application and we rerun the credit, and it's like, what happened to my 800 score? And it's literally, it could be like, I've seen a $50 late payment on an Apple card, a Macy's charge card, drop it 100, 120 points. And by that time, good luck calling Macy's to try to get that removed. They're not taking it off. I've had people that have tried.
Exactly.
Micah, we just for time's sake, I mean, we could sit here and probably talk for like an hour.
Probably longer. Probably a lot longer.
just out of respect for your schedule and Christian's, I think we'll maybe wrap up for today. But if you don't mind, I mean, we'd like to have you back on in a couple of weeks just to kind of dive deeper into this, because in my business, again, as I said, I speak to buyers all the time and they just don't understand the intricacies and the options that are out there. And I think having somebody like you as a valued resource is extremely beneficial for them. And I always recommend speaking to you or speaking to somebody else as far as like getting your credit repaired. So that way, then I could kind of move them along to Christian so that way he can get them pre-approved. And then at that point I can set back in and help them find a home. So, just from my point of view, I just want to say thank you so much for what you do. I think it's extremely important and extremely underrated, especially for people that are doing what I'm doing and what Christian's doing.
Thank you so much. We love what we do here so much. Thank you.
I have just let me see here. So I put on the bottom there, I put your email address there. So in case anybody wants to get in touch with you. Absolutely. And once this post, like right now we're live on Facebook, on LinkedIn, on YouTube. So what I'll do is I'll go back in the description and I will put your contact information in there as well. And I thank you very much for your time. And Christian, same to you.
Yeah, thank you. Thank you, Micah. Great to see you.
My pleasure. Good to see you. Thanks, guys.
Bye, guys. Take care.
See you soon.
Bye-bye.
Bye.